Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. With the real estate market at all-time highs, today we're going to talk about 1031 exchanges, which can help you defer or even possibly eliminate real estate taxes. So help me to explain this is Greg Smith, the Ohio Manager for the Investment Property Exchange Services, the country's largest qualified 1031 intermediary. So Greg, let's start with explaining what exactly is a 1031 exchange.
For someone who sells investment real estate, it's the opportunity to reinvest into more property without paying any state or federal taxes. This can be used by everyone from giant companies with huge holdings to someone with one small rental property.
So tell us the basics of how this strategy works.
Yeah, simply put, a 1031 exchange is reinvesting from one property into another in a manner that can stay tax deferred. The name comes from IRS Section 1031. And it is important to know that 1031 does need to be in place before the initial sale.
There are some very specific guidelines the seller has to abide by. So from the time they close the deal, the seller has 45 days to identify the replacement property to buy and has only 180 days to close on the new property.
Yeah, that's right. And to obtain 100% tax deferral, the exchanger needs to reinvest all of the net proceeds and replace the debt, either with new debt or new cash. Most exchangers buy a property of equal or greater value.
So these are often called Likekind exchanges, but let's help the viewers understand what really is a Likekind exchange.
Exchanges are very flexible. An exchanger can sell any type of real estate used for productive use in a trade or business or for investment, as long as they trade it for the same thing, more real estate used for productive use in a trade or business or for investment. And you can sell residential and buy commercial. You could go out and sell an office building and buy a shopping mall. The rules are very flexible.
So let's say you bought a property for $400,000 15 years ago, and now it's worth $700,000. Some people might think you only have to pay taxes on that $300,000 gain, but that isn't necessarily the case.
Special rules apply when a depreciable property is exchanged. There's depreciation recapture, which can be a 25% tax. So when you start talking about the depreciation taxes, the appreciation taxes, and the state taxes, in the end, taxes can be brutal.
So in the way this gets applied depends on your personal income tax bracket and some other factors, but it could result in over $100,000 in taxes to you. But the 1031 exchange defers all that taxes into the new property.
That's right. And the qualified intermediary is used to hold the money from the time of the sale until it's used for the new purchase. And we provide all of the documents needed for a valid 1031 exchange.
Well, that's great. Thanks, Greg. As you can see, properly using a 1031 exchange can be extremely complex to help delay or avoid a significant amount of taxes when it comes to real estate. So if you have any questions, give us a call. Here's Chris Wall.